Ottawa's May numbers just dropped. Sales are down 10.6% compared to last May. Canada just officially entered a technical recession. And less than a month from now, every federal public servant in this city is being mandated back to the office 4 days a week. That's a lot of headlines hitting at once. So let me cut through the noise and tell you what's actually happening in Ottawa's real estate market right now. And also, why our market is more stable than what you're seeing in Toronto or Vancouver. I'm Eric Bekkers, a local realtor here in Ottawa, and let's dive in. And be sure to stick around to the end because I'm going to tell you the one segment of the Ottawa market that I'd be cautious about right now, as well as the one I'd be most aggressive if I were buying today. They're not the same, and the answer will surprise you. Start with the headline numbers. 1,616 homes sold in Ottawa in May. That's actually up from 1,336 in April. So month over month, activity is increasing. This is normal spring lift. But let's go back year over year. Sales are down 10.6% compared to May of 2025. So here's where it gets interesting. The average sale price was $721,217. This is up from April and down less than 1% if we compare to May of last year. This is a balanced market. The median price was $660,000, up $10,000 from April and down 1.6% year over year. Balanced again. So the real headline is this: fewer transactions, but prices essentially flat. And this tells you something important. Buyers aren't gone, they're being selective. And here's where a lot of market updates and news headlines actually stop. They give you the citywide average and then move on. That citywide average is hiding three completely different stories. Now let me walk you through them. Starting with single family homes. These are the strongest segment in Ottawa right now. 904 detached homes sold in May. Average price essentially unchanged year over year. Median price is up 1.3% to $800,000. The benchmark price, the more reliable measure than the actual averages, it actually rose 0.3% year over year. So what does all this mean? Once again, this is a market that everyone is saying is slowing down, but detached homes have held their ground. Months of inventory in this segment sits at 2.7 months, which is still very seller-friendly territory. So if you own a detached home in Ottawa, maybe Greeley, Manotick, Riverside South, check your equity. If you're buying a detached home, don't expect prices to drop. They haven't. Now, townhomes are a little bit of a different story. 481 townhomes sales in May. This is down 14.3% year over year. Benchmark price for townhomes sits at $557,500, which is actually down 3.2% compared to last May. Months of inventory here is also at 2.7, same as detached, but the price pressure is a lot more real. This matters. This matters for Barhaven, Finlay Creek, matters for anyone holding a townhome that they bought at the peak in 2021 or 2022. It's not a crash completely, but this is a declining market. It's not where it was. Now, condos and apartments are the softest part of this market by a lot. 203 apartment style sales in May. Benchmark price at $385,000, down 6.7% year over year. That's big. Months of inventory here is at 4.8. So compared to the 2.7 of single families and townhomes, this is by far the highest in any segment. So if you're a condo seller right now, you have to price correctly, market well, and still gonna require a little bit of patience. If you're a condo buyer, there are deals out there if you're patient and find the right seller. So what's happening in the South End? I like to zoom in a little bit on where I personally live. The Ottawa Real Estate Board breaks the city into subregions. Ottawa South, which includes my market, is described as steady but softer than last year. That's technical language, so let me translate. Activity is happening. Homes are selling, but not at the pace of 2025. Detached homes in the South End have held up, consistent with citywide single-family story. The interesting move was in Ottawa Centre. Sales were up 13.5% year over year. Prices also up. Downtown core is showing real signs of life. But for my South End audience, we're in a steady market, not hot. Not crashing, just steady. With more inventory than we had this time last year, which means buyers have more options, more negotiating room than they did 12 months ago. But the May numbers don't tell the full story just yet. Two things just landed on Ottawa's lap that you need to understand. The two biggest forces that people are talking about but not connect. Here's where Ottawa is different from every other major Canadian market right now. The two things that just happened actually pull in opposite directions, and they matter more here in Ottawa than anywhere else in the country. Force number one is the recession. On May 29th, Stats Canada confirmed that Canada is in a technical recession. Now, whatever you think politically, these are the numbers, and the numbers do not lie. Q4 of 2025 was down 1%, and Q1 of 2026 was down only 0.1%. 2 consecutive negative quarters, which meets the definition of a recession. Now, some economists are pushing back on the label. April already showed a 0.4% rebound. Bank of Canada has been steady, and there's forecasting for growth strengthening through the rest of 2026 and into 2027. So maybe it's technical, maybe it's not. It might be already turning, but it's real. It's still a recession, and recession slows housing market. Buyers get cautious, sellers get nervous, activity drops. So that's the headwind pressure for the Ottawa Real Estate Board. And there's a related piece. The federal government has announced cuts of 28,000 positions over the next few years. 26,000 workers have already received workforce adjustment notices. In a city where the federal government is the single biggest employer, this is real. I'm not going to pretend otherwise. Now, the force number two going the opposite direction is the return to office mandate. So here's the other side. As of May 4th, federal executives are required back in the office 5 days a week. As of July 6th, less than a month away, every public servant in the core public administration is going to be required to be in the office a minimum of 4 days a week. This includes Canada Border Services, Health Canada, Natural Resources, Public Services and Procurement, Stats Canada, most of all the major federal departments. So think about what that means. Thousands of public servants moved during the pandemic. They bought homes in cottage country, Kemptville, Smith Falls, Renfrew, North Gore, places where 45-minute drive to the office once a week was fine. 4-day-a-week mandate changes that math completely. You can't commute from Smith Falls 4 days a week. Well, you can, but you won't for long. Some of those people are going to move back toward Ottawa, toward maybe the South End, still a little bit more space but closer in, Barrhaven, Riverside South, Greeley, Manotick. This is considered a tailwind. It's a tailwind that's unique to Ottawa compared to the other major cities. So why does this matter? Here's the part I want you to hear clearly. Every major Canadian city is dealing with the recession. Ottawa is the only one also getting a uniquely large return to work push. Recession pulls demand down, return to work puts demand toward Ottawa specifically. For Ottawa, those forces will partially offset. For Toronto, Vancouver, Montreal, they don't have the same offset. They're only seeing the headwind. This is why Ottawa's market keeps showing up as balanced, while other cities are swinging a lot harder in both directions. This is why our prices have held while sales have softened. It's why I expect us to keep being one of the more stable major markets in Canada through the rest of the year. Now, people call this boring. They call Ottawa boring, but hey, stable, not booming, that's a market I think most people would be okay with. Inventory is elevated. Active listings sit at almost 5,000 units citywide, up 12.2% compared to last year. You have choice. Days on market are sitting a little bit longer. Homes are sitting. That gives you time to think, time to inspect, time to negotiate. None of that existed in 2021. The sales to new listings ratio is 48%. This is balanced territory. Rates are stable, Bank of Canada has been cautious. This removes a lot of the panic that was driving buyer behavior about 18 months ago. Now you have the return to work factor. So if you're a buyer thinking about Ottawa, South End maybe, Finley Creek, Riverside, Orleans, maybe like the East, you're moving toward the demand wave, not away from it. Public servants moving back from cottage country are going to be looking at the same neighborhoods you are looking at. Eventually the window where you have leverage and they haven't moved yet, that's now. So the window where you have leverage and they haven't moved yet, that's right now. If you've been sitting on the sidelines waiting for prices to crash, prices haven't crashed. And hey, it's not coming. They've stabilized. What you've actually got is time. Time to look, time to negotiate, time to be picky. That window doesn't stay open forever. So let's shift over to what this means if you're selling. This is a different conversation. You're now competing with active inventory being way up. Buyers are picky. The homes that sold in 3 days last year take 3 weeks now. If it's priced wrong, it's going to be even longer. Pricing strategy matters more than ever. I've seen homes sit because they were priced where the neighbor sold in 2022. The market doesn't care what your neighbor sold for. The market cares what's selling today. Presentation matters more than ever. Staging, photos, cleaning, prep work. The buyers have options. Yours needs to be the obvious choice. If you're in a single family detached home in the South End, you're in a stronger position than most. The data shows it. The return to office wave supports it. Don't let the headlines scare you into underpricing. If you're selling a townhome or a condo, get serious about strategy, and if the timing is right, price it right out of the gate. Don't chase the market down with 3 price drops. That's how listings die and become stale. So my take and what I'm watching. The segment I'd be the most cautious about right now is apartments and condos. 6.7% year-over-year price decline. The highest months of inventory in the city. Investor demand is soft, and there's no clear catalyst for a quick turnaround in this segment. If you own an investment condo, you need a real plan, not hope. Maybe renting for another year or 2 is worthwhile. Now, the segment I'd be the most aggressive in if I were a buyer right now is the single family detached homes in Ottawa's South End. Here's why. Prices have held. Inventory is up, rates are stable, HST rebate on qualifying new builds up to $1 million is in effect through March of 2027. This is all real leverage for buyers looking at new construction in places like Riverside South, Mahogany in Manotick, Finley Creek, or new builds in Greeley's Forest Lake Estates. On top of that, you've got the return to work migration starting in less than a month. Public servants who can't commute 4 days a week from Smith Falls, North Gore are going to be back in the South End market. Move-up buyers been sitting on the sidelines for 18 months. They're starting to come back. The inventory you can negotiate on today is the inventory someone else negotiates on in 6 months at a different price. So that's my take. Thanks for sticking around. If you want to know what your specific neighborhood is doing, not the citywide averages, but the actual data from your street, that's the conversation that I want to have with you. So check out the description, see a link to my calendar, and book a 15-minute consultation. Let's just talk real estate. It's what I love to do, what I do every day. Pull the comps for your neighborhood, your property type, your situation. I'll tell you exactly where you stand. Subscribe if you want to see the next market update and other helpful videos about buying real estate in Ottawa. I do these monthly. See you in the next one.